Welcome to Breaking News to Training Moves. Today we're looking at a financial report that really shines a light on where capital is flowing, and that's into the massive, accelerating need for AI-ready data center infrastructure.
Exactly. This one report gives us a pretty clear window into the competitive dynamics forming around high-power computing capacity. The physical backbone of this whole AI boom. We're going to look at who's benefiting and who's facing some immediate pressure.
Right. Our job here is to just distill that core headline, map out the companies being lifted by the trend, and also those being put under some strain. So let's get into the event itself. It centers on Applied Digital, ticker APLD. They just reported their fiscal Q2 revenue.
That's right. For the period ending November 30th, the number they reported was $126.6 million.
And that was well above what analysts were expecting, right?
Oh, yeah. Substantially above. The consensus was somewhere around $88 million. And the company was very clear. They said this outperformance was driven by demand for large-scale AI data center capacity.
And the market, of course, reacted. Shares of APLD jumped about 7% after the announcement.
But it's more than just a single earnings beat. It's about what's creating this demand. See, AI workloads require this sort of land grab approach for AI-ready data centers.
Okay, and what makes a data center AI-ready? I think this is key.
It really comes down to three things, and they're all non-negotiable.
What's the first one?
First is just massive power availability. We're talking in megawatts, or MW. The power draw for training these models is just immense. A single campus can use the same amount of power as a small city.
A small city.
Okay.
Okay, and I'm guessing if you need that much power, getting it built quickly is a problem.
That's number two, fast construction execution. The ability to build these things, to get the grid connected, to deploy all the cooling. That speed is a huge competitive advantage.
And the third piece?
Long-duration lease contracts. This is what investors want to see. Locking in major tenants for, 10, 15 years.
And Applied Digital seems to have checked all three of those boxes.
They did. They pointed to a huge lease agreement, about $5 billion for 200 megawatts at their North Dakota campus. That was on top of leases they already signed with two different hyperscalers there.
Up to 200 megawatts.
Yeah.
To put that in perspective for you, that could power something like, what, over 100,000 homes?
Well over. It just shows the scale of the commitment. These aren't short-term deals. They're infrastructure partnerships.
So this APLD news really validates the whole sector. Let's talk about the winners. Besides APLD itself, who else is benefiting here?
Well, the first group is pretty direct. The other AI data center developers and operators, they are, effectively the landlords for the AI age.
And you mentioned investors. They're starting to look at these companies a little differently, aren't they? Comparing them to something like a REIT.
That's the crucial part. A REIT, a real estate investment trust, is usually seen as stable, predictable. If these builders can lock in a tenant like a Microsoft or an Amazon for 15 years, that cash flow starts to look almost like a bond.
Which means their asset utilization goes up, their contracted revenue backlog looks solid.
Exactly. And if they can prove that stability, they can get cheaper financing, which just fuels more growth. It's sort of a paradox. The goal is for your high-growth tech company to be valued like a boring utility.
So that puts companies like Equinix, ticker EQIX, and Digital Realty Trust, DLR, right in that same bucket.
For sure. Now, the second group of winners is the supply chain behind them. Building these campuses requires a ton of specialized, heavy-duty equipment.
Right. This is the stuff that makes it all work. The power systems, the cooling, the grid equipment.
Every single megawatt of new capacity pulls through a huge amount of capital spending into that supply chain. We're talking about advanced thermal management, high-voltage gear.
It's all essential infrastructure to support that land grab we talked about.
So you're looking at companies like Vertiv, that's VRT, which does power and cooling infrastructure.
Oh.
Then there's Eaton, ETN, for heavy-duty power distribution, and Quanta Services, PWR, for the actual large-scale electrical construction.
Okay, and that brings us to the third group of winners, who are basically the customers driving all this, the hyperscalers.
Right. For them, securing this physical capacity is critical. It reduces bottlenecks in their own growth plans.
Fewer bottlenecks means they can train their models faster, roll out their cloud AI products more efficiently.
Their success is directly tied to getting access to this infrastructure. It's an arms race for physical space and power.
So we're talking about Microsoft MSFT, Amazon AMZN, and Alphabet GOOG. Their entire AI strategy depends on these builders succeeding.
Absolutely.
All right, so let's flip the coin. When so much capital and so many resources are flooding into one area, it has to create pressure somewhere else. Who's feeling that?
The most immediate group facing pressure is Bitcoin miners, specifically the ones who don't have a strong AI pivot.
Because they're competing for the exact same resource.
The exact same one.
Yeah.
Cheap power. And an AI data center with a 10-year lease from a hyperscaler can simply outbid a miner for that power. So miners can see their energy costs go up and their access to new sites just shrink.
So that puts pressure on companies like Marathon Digital, MARA, Riot Platforms, RIOT, and CleanSpark, CLSK.
It does. And beyond just power costs, capital starts to rotate away. An investor can choose between volatile Bitcoin revenue or 10 years of contracted cash flow tied to AI. That's an easy choice for a lot of money managers.
Okay, that makes sense. Who's the next group feeling the strain?
This is more of a relative performance issue. It's the office-focused REITs.
So not a direct competition, but more about where investors are choosing to put their money within the real estate world.
Exactly. An investor looking for growth and predictable cash flow from real estate now has a choice. They can look at the data center story tied to this relentless AI demand, or they can look at an office portfolio, which, is dealing with work from home trends and higher vacancy.
So even if there's no bad news for the office REITs themselves, capital just prefers the AI infrastructure story right now.
Precisely. And that can weigh on the relative performance of names like Boston Properties, BXP, or Vornado Realty Trust, VNO.
Okay, and there's one more group you identified, the smaller players in the AI space.
Yes, the smaller AI software companies. For them, the scarcity and the rising cost of this computing infrastructure is a direct threat to their bottom line.
Because if you're a startup trying to build a new AI application, you have to pay for that compute time, and those bills can get very high very fast.
And if the hyperscalers are leasing all the capacity with these massive long-term deals, it leaves the smaller companies fighting over the scraps. They end up paying higher spot prices, which can just destroy their path to profitability.
It makes it harder to compete. They might have to slow down their research, limit their models.
It creates a huge cost advantage for the big, well-capitalized incumbents we mentioned earlier. It's a structural headwind for the little guys.
So we're talking about companies like C3.ai, ticker AI, and maybe SoundHound AI, SOUN. Their business models are very sensitive to these rising infrastructure costs.
Yeah, what we're really seeing is an entire ecosystem responding to the demands of AI. And that response creates these really defined groups of winners and losers. And it all seems to be based on who has access to power and specialized infrastructure.
So for you listening and tracking this space, the key might be to watch for those headlines about MW plus long-term lease deals. Those kinds of announcements tend to lift this whole AI data center sector.
Absolutely. Watch for new hyperscaler leases or any of these companies talking about a formal transition to a REIT structure. Those are the real indicators of continued durable demand.
As always, please remember that the discussion and opinions shared here are purely those of the author who provided the content. This is not financial advice, nor is it a recommendation to buy or sell any security. Always conduct your own research before making any investment decisions. Thank you for joining us for this analysis on breaking news to trading moves.